Okay, this is a video going over the Chapter 1 most missed questions on the Chapter 1 exam. Let's go on our first question. ABC Company's balance sheet reported assets of $57,000, liabilities of $18,000, and common stock of $15,000 as of December 31st, year 1. So there's our December 31st, year 1 accounting equation. Let's plug in what we know. We know assets are $57,000. We know that liabilities are $18,000. We know that common stock is 15, and we can find retained earnings by adding these two together, 18 and 15, subtracting them from 57, and we'll get 24,000. Because the left side of this equation, which is 57,000, that's the asset side, has to always equal the liability equity side, which in this case, all three of these pieces add up to 57,000. Now, what they want to know is, what was the amount of net income for year 2? Remember, this is at the end of year 1, which is the same thing as the beginning of year 2. So here is at the end of year 2's accounting equation, and what we're trying to find is something that happened in here between beginning of year 2 and the end of year 2. And what happened was the company earned money, and the way they figure this out is you take the beginning retained earnings, and we'll plug in some more things that we know now. We know that the ending retained earnings were $30,000, so retained earnings went up $6,000 during year 2. Now there's only one way they can go up, which is to have income, and the way that retained earnings goes down is to pay out dividends. So it looks like the company paid out dividends of $17,000, and it's still the retained earnings still went up $30,000. That $30,000 is after everything had happened. That is, after all the income and after all the dividend payments. So what we're trying to find out is, what is net income in year 2? So 24 minus the dividend payment plus whatever net income was had to equal $30,000. Well, if it went up $6,000, even still after you paid out this dividend of 17, the net income must be the difference between that $17,000 and the $6,000 increase, which makes it $23,000. And you can check this by saying 24 minus 17 plus net income of 23 should equal 30, and it does. Let's go to our next question. This question wants to know, what would the amount of expenses be on the income statement? All right, it says the year-end financial statement of ABC Company contained the following elements. They had, let's put our accounting equation up here. Remember, this has always got to be in balance, and it's always got to be in balance at every point in time. And so they gave us the year-end information for this company. So it says here that year-end assets were $38,000. Liabilities, we don't know. It also tells us that we had year-end common stock of $68,000, and it also tells us that we had ending retained earnings of $8,800. Now we can figure out what liabilities are, but let's just see if we even need to do that. What we want to know is, what were the expenses during this year of operation? So here's something to keep in mind. They did tell us that the beginning retained earnings at the beginning of the year was $46.50. Now, if you remember anything from the previous problem, if your beginning retained earnings are $46.50 and your ending retained earnings are $8,800 during this year, that means that retained earnings went up, and the way they go up is by having income. The way they go down is by having dividends. Now, did we pay any dividends? Yes, we paid out dividends of $16.50. So let's see what we got here. We've also, like I said, net income is a product of revenues minus expenses. So from our beginning retained earnings for year 1, we added revenues during this year of $14.6. And what else? We want to know what expenses were, right? So that's the question mark that we're trying to figure out. And we also know that we paid out dividends of $16.50. So what I'm really trying to figure out is this. If I began retained earnings at $46.50, I had revenues that increased retained earnings by $16.5, expenses that are going to lower retained earnings by I don't know how much, But I do know that dividends were $16.50. That's reduces retained earnings, and I also know that the ending retained earnings, after including all of these things, ended up being $8,800, which, like I said earlier, was an increase. So all I've got to do is say 4650 plus 14.6 minus something minus 1650 equals $8,800, and I'll do that. I'll do that horizontally. Might be easier to see. Beginning retained earnings 1450 plus revenue of 14.6 minus expenses of we don't know minus dividends of 1650 equals $8,800. Now we're solving for the unknown, which is expenses. We're combining all these things right here, which is this plus the 14.6 plus 1650, which is going to be a net 17.6 minus expenses equals $8,800. So 17.6 minus what will give you $8,800, and the answer is expenses have to be $8,800. And you can plug this back in to right here, and you'll see that it all checks out. Next question. Before we get to the next question, the next several questions deal with the classification of cash flows. And just to give you a real good general overview of this, there's three kinds: operating activities, investing activities, and financing activities. And really, cash flows, what we're dealing with here is what happened to your cash, where is it, how much do you have as a beginning balance, as an ending balance, and how much did it change? And that's called a cash flow statement. I'm not going to get into a cash flow statement any other right now, but for this situation, you need to know this. Operating activities, when it relates to cash flows, are any kind of cash that came into or went out of the balance sheet, which really are revenues and expenses. So income statement items are operating activities as far as cash flows. Investing activities are things that have to do with either buying or selling long-term assets. And by that I'm talking about equipment, or I'm talking about land, building, that kind of thing. And then the third type of cash flow that a business gets is what's called financing activities. This would either be issuing or repurchasing their stock, the common stock. That's one type of financing activity. Issuing or paying off debt. That's another type of financing activity. And the third type of financing activity would be dividend payments. So operating activities are income statement items, revenues and expenses. Investing activities are buying or selling assets, long-term assets. And the financing activities are either buying or selling stock, repurchasing stock, whatever, taking out debt or repaying debt, and then also making dividend payments. Keep those three things in mind on these next several questions. Okay, this question wants to know what would be the net cash flow from operating activities. Remember, that's the things that are going to be only appearing on the income statement, right? Revenues and expenses. So we go through this list here, and we go through the accounting equation, and we'll go through these transactions this time, and then we'll pick out the things that would only appear on an income statement. That would be revenues and expenses. So issued stock for $68,000, assets go up, equity goes up under common stock. Borrowed $39,000 from the bank, assets go up under cash, and liabilities go up. Provided consulting services for $66,000. That's a revenue transaction. Assets go up under cash, and equity goes up under revenue. Then we paid back a $29,000 bank loan. So cash goes down $29,000, and liabilities go down $29,000. Then we paid rent expense for $16,000. That's operating activity. That's going to be on the income statement as an expense. Cash goes down $16,000, and expenses go down $16,000. Then we purchased equipment for $26,000 cash, and that's one of these things where assets go up when you buy the equipment, but assets also go down when you look at the fact that it was paid for by cash. So cash goes down under assets, equipment goes up under assets, and overall assets don't change. Next, we paid $4,400 dividends to stockholders. So cash goes down $4,400, and equity goes down under dividends of $4,400. And then last but not least, we paid employees salaries of $35,000. So cash goes down $35,000, and equity goes down $35,000 as an expense. So operating activities would be $66,000 from consulting services, that's revenue, minus the outflow for rent expense, which is $16,000, we paid for that, minus the salary expense, we paid for $35,000. So combining all these things together, our net cash flow from operating activities would be $15,000, and it's a plus, so it's an inflow. Next one. They want to know what would be the ABC retained earnings account balance at the end of year one before the process of closing accounts has been undertaken. This could be considered a trick question if you are not very familiar with accounting or have not read very well deep into this. And so here's what the answer basically is. Since the closing process has not been completed, that is, we haven't done anything to close the books, the retained earnings account balance at the end of the, and this is important, at the end of the, and this is important, at the end of the first year is always going to be zero. When you first start a business, retained earnings is zero until you start adding income into it. So if you haven't closed the books, so the question wants to know the ABC retained earnings balance at the end of year one before the processing closing accounts has been undertaken, it's zero. Next, they want to know what is the amount of retained earnings on the ABC company's year two balance sheet, year two. So we have ABC has transactions for year one, they have transactions for year two, and they want to know what's the retained earnings balance at the end of year two. Well, first thing we're going to do is we're going to start off with the retained earnings balance of zero, and then we're going to add things and subtract things from year one that are going to affect retained earnings. And the only things that affect retained earnings are revenues make it go up, expenses make it go down, and dividends make it go down. So from these transactions here, we've got the following. Plus $1,500 for revenue, that's $1,550, minus expenses of $440, right? And paid out a dividend of $240. We don't count issuing common stock because that has nothing to do with retained earnings. And we don't count borrowed money from the bank. That only affects cash on the asset side and liabilities. Look up past transactions, you can see. So when we combine all these pieces, we end up with an ending year one retained earnings balance of $870. That's important because we're going to carry that balance forward into year two because we need the amount of our retained earnings balance at the end of year two. So at the end of year one, same thing at the beginning of year two, $870. We want the ending balance of retained earnings. So we're going to go through these transactions and pull out the same things. What things affect revenue, affect retained earnings from these kind of transactions? And we know when there's our starting point, 870, we'll add revenues, which would be something that's going to increase retained earnings. We'll subtract out expenses, which reduces retained earnings. And we'll also reduce retained earnings by paying out dividends. So our end of the year retained earnings balance for year two, combining all these things together, would be $1,540. Next transaction. This one they want to know, what is the net cash flow from financing activities for year two? And just to refresh your memory, a financing activity could be any one of the following things. When you buy or issue stock or repurchase stock, when you have new debt or pay off debt, or when you pay out dividend payments. So when you look through these transactions right here, here are the financing activities. They are cash inflow for issuing stock, $1,000 right there, that first transaction. Next one would be $1,650 for cash outflow of a loan repayment, which would be this $1,650 right here. Then we've got $1,240 cash outflow for dividends. That was this one. And that's our total, which is going to be a total net cash outflow since it's a minus number here. That should be a minus in there somewhere. Cash outflow for financing activities for $1,890. What we didn't include in here were expenses, which is something that goes on the income statement, which is an operating activity. And also we didn't include revenues, which again is another operating activity. All they want were financing activities.